we have a crisis on household balance sheets. How did we get here?
Yeah, the high household debt levels of Canadians will lead to a weakened economy and maybe even price decreases. This, according to my interview with David Rosenberg of Rosenberg Research. Rosenberg and I not only discuss Canadian debt levels, but also the Canadian economy, the mortgage renewal wave, and the outlook for the Canadian housing market heading into 25 and 26. We will obviously continue to track all of these issues on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. All right, so today I'm joined by David Rosenberg of Rosenberg Research. David, I just want to thank you so much for being on the show today.
Well, and I want to thank you back for inviting me on.
Definitely. So I do want to get right into this, as you had a interview with Bloomberg a few weeks ago, which I covered on this channel, where you said if the Bank of Canada doesn't get moving quickly, we're at risk of 0% inflation or even deflation. Would you
Mm.
mind going into that a little bit?
I think that what's very interesting was that the Bank of Canada, and they're not alone. I mean, you can argue that the Federal Reserve in the US is guilty of having made the same mistake yet again, but in the opposite direction. And so the central banks thought that inflation was transitory coming out of COVID and all the policy responses without really ever defining what transitory meant. For a single month, we hit 8% inflation in Canada. That's true. 9% in the United States. That's true. But it was not the 1970s all over again. And we hit these egregious levels on inflation for the grand total of 1 month. And I would posit that in the overall annals of economic history, 18 months actually can be defined as transitory. So I guess we could debate that the Bank of Canada, along with the Fed, stayed too loose for too long. And that's obvious with perfect hindsight. But then what they did was dialed up interest rates and tightened policy. I mean, in the United States, you had the tightest monetary policy since the Paul Volcker years of the early 80s. And in Canada, Tiff Macklem followed on the footsteps of John Crow in the late 80s and early 1990s. Both periods, early 80s, early 90s, tough times and recession in Canada, because in a credit-driven economy, interest rates matter, and they hit the economy with lags. And we've seen those lags play out big time, especially in the credit-sensitive sectors of the economy. So from my lens, the big policy mistake the Bank of Canada made was when they continued to tighten monetary policy in the spring and summer of 2023, even though at that point we were starting to see a significant shift in the supply and demand curves in the Canadian economy, where we started to develop what's called the disinflationary output gap. But I guess the Bank of Canada wanted to take out extra insurance on the inflation file and hike rates 2 more times when it really should have just stayed on hold. And so these last two rate cuts, the initial two rate cuts that the Bank of Canada initiated in the past few months, instead of everybody dancing around and saying, oh, the Bank of Canada is cutting interest rates, well, all they've really done is just eliminate the policy error that they made just over a year ago. So that's really what's happened here, is that the Bank of Canada has tightened monetary policy. They took interest rates up more than 400 basis points at a time when we have a crisis on household balance sheets. Everybody complains about, government deficits, government debt. That's not where the crisis is in Canada. The crisis is on household balance sheets. The debt to income ratio in the Canadian consumer sector is 177%. That's practically unheard of. And it's double what the debt to income ratio is in the detested government sector. So everybody wants to preach the government about how to run its finances. And take a look what's happened in the Canadian household sector. 177% debt to income ratio at the peak of the credit bubble ridiculousness in the United States when I was toiling for Mother Merrill back in the 2000s, 2007. And we know what happened next. The peak of the household debt income ratio in the United States that precipitated the crisis was 135% debt income. In Canada, it's 177% as you and I speak. And what that's meant with the run up in interest rates bumping against this incredible debt burden is that for the Canadian household sector, 15 cents of every after-tax dollar earned is now being siphoned off into interest payments at your local bank. That money doesn't go into the economy. It goes into debt service at the banks. And that's the same ratio, 15%, call it interest expense to income ratio, that touched off each of the past 4 recessions. So I think that's really the principal situation here, is that we have a debt crisis on the household balance sheet bumping against these onerous interest rates. And the Bank of Canada has done its own mea culpa, because at the last meeting, it uttered the words excess capacity not once, not twice, but 3 times. The Bank of Canada is now talking about excess supply, ergo disinflation. And they are rather forceful about it. But if we're in an excess supply backdrop in the Canadian economy, then the overnight rate has no business even being at 4% after these 2 rate cuts. The bank's own estimate, the midpoint estimate of where it considers the neutral interest rate to be, the interest rate that exists in Nirvana, full employment. We're no longer at full employment with a 6.4% unemployment rate and price stability. And we're back to price stability, and maybe even more than price stability when you look at the underlying inflation numbers. We should be no higher than 2.75% right now. Right now, the Bank of Canada is still 125 basis points too tight. But you see, at the last meeting, they told us something very important, which is that even under their assumption that the economy rebounds, we're still going to be in an excess supply backdrop where aggregate supply is outpacing aggregate demand by the end of 2026. So when you run these numbers in your model, this lingering excess supply in the economy, which is disinflationary, and looking at the fact of where we are right now on inflation and core inflation, that lingering excess supply between now and 2026 is going to take the inflation rate to 0 and the unemployment rate up to 8%. That's really what the underlying message was. Now, the Bank of Canada will never come out and forecast those numbers. They don't want to create hysteria. But that's what falls out of the data, given the information that they provided for us. So they have a long road to hoe. They have to get interest rates way down in order to generate the end of the excess supply backdrop. It's I think incontrovertible that this is not going to go away in the next year. But to prevent a deflationary backdrop heading into 2026 and beyond, the bank has got to take rates down. I'm not saying we have to go back to the 0 bound, but I think certainly we have to go back to 2% or lower.
Let me ask you, because I think when I covered your video, a lot of my viewers said, great, disinflation, let's do it. Prices are up roughly 20% since 2020, but wages are only up about 12. So I think a lot of people think that disinflation, the reduction of prices, would actually be a good thing. But I'm guessing the bank doesn't see it that way.
Well, look, it's a classic case of being careful what you wish for. It's one thing if we're getting disinflation in the context of a labor market that's vibrant. But you see, we don't have a labor market that's vibrant anymore. We have a situation where in the past year, for example, 60% of the people that came into the workforce looking for a job actually landed a job. This time last year, that number was well over 70%. So fewer people who are coming into the labor market looking for a job, fewer are finding a job. With a lag, that is going to put downward pressure on nominal wages. So I think that you're quite right that if we have, if you want to call it declining prices, or certainly what inflation is the rate of change in prices. Normally, that's not a bad thing. But for the consumer sector, it's a race between what's happening with wages and what's happening with prices. So I think that what's likely to happen is that you're going to get prices disinflating, or we may get into outright deflation. There is a chance that's going to happen. When I say that our models, given the excess capacity in the economy, is going to take us down to 0% inflation, which is a nobody's forecast. Nobody would dare on Bay Street ever forecast 0% inflation. Your bosses wouldn't let you do that because of what it means for the economy. What it means for the economy is that that's commensurate with the unemployment rate going up to 8%. So going up to 8% of the unemployment rate naturally is going to put downward pressure on wages. So you're going to get wage compression alongside price compression. And the only way that real wages will be underpinned in that environment is if the prices end up decelerating faster than the wages do. My sense is that it's going to be a very close race. But at the same time, we can't ignore, as we talk about deflation, and I'm not talking about a specific metric, I'm talking about just general deflationary pressure on the economy. The excess of debt on household balance sheets, considering that the consumer is over 60% of Canadian GDP. That debt is a chronic source of depressant on aggregate demand and consumer spending. The debt is just way too high. Think about what it meant in Japan to have that inordinate debt for so long and what it did for the economy. So we're also going to go through a prolonged period where the household sector is going to be forced into a prolonged period of frugality and balance sheet repair. And that's going to be a drag. I mean, it's necessary. We always talk about how the governments have to tighten their belts. This is even more acute in the Canadian household sector. And it's going to take a while to play out. But in the interim, it's going to act as a depressant on inflation and economic growth. And to me, when you're going to ask me, there's lots of things in Canada that are going wrong. I don't mean to be a Debbie Downer, but I do believe that economists are paid to tell the truth. And we have a crisis on household balance sheets in this country, and we have a crisis in productivity in this country. And it'd be just wonderful if we could get that disinflation through the supply side. If we could go through a situation where through the tax system or regulatory system that we could basically revive what is a truly dormant sector for private sector investment. I don't think most people know this, but the private sector capital stock in Canada, the productive capital stock, is lower today than it was 10 years ago. So part of the problem is that we don't even have vibrant supply conditions beyond immigration. So it'd be one thing to have the disinflation or deflation in a situation where we had decent demand growth, but booming supply growth. That does create an output gap, but demand at least is doing well, but supply is doing even better. That leads to much better outcomes for the macro backdrop and for the financial markets. But we don't have that. We have weak demand because the debt is just too damn high in the most critical part of the economy called the consumer sector. And we have another problem, which is the ever expansive government sector. You know, we have government now accounts for 26% of GDP. You know what private business investment accounts for? 8%. 8%. The government is more than 3 times larger than the business sector in this country relative to the size of the economy. And of course, an economist talks to a layperson about this and they just roll their eyes, like, what are you talking about? Well, ultimately, we're going to create productivity growth long-term in this country through government increasing its size and relative share to the economy, or the business sector. I think the answer is obvious. In the United States, for example, the share of business investment to GDP is 14%. In Canada, it's 8%. In the United States, productivity growth is running at 2.7% over the past year. Where is it in Canada? Negative 0.9. Negative 0.9. So we have a recession in business investment, and we have a recession, a chronic recession in productivity. And why that's important is that productivity is the mother's milk for future economic growth. So that's part of the problem here, is that we have two very weak curves bumping against each other, a weak demand curve and a weak supply curve. It just so happens the demand curve is weakening faster than the supply curve, primarily because we have 3.5% population growth here by virtue of the immigration boom that we've been incurring over the course of the past few years. And that's created its own problems. However, there's no really simple answer here. And we didn't get an answer in the last budget, which was concentrating more on income redistribution than it was towards fostering growth in the private sector capital stock. That's really one of the critical things that's missing in this country.
So I want to ask you about Canadian household debt. Do you have a few more minutes? I know we only scheduled for
Absolutely.
15.
Sure.
So I think a lot of people would say the Bank of Canada cuts rates and that debt's going to go even higher.
No, that's not going to happen
No?
because if you're taking a look at consumer insolvencies, they're rising inexorably. You're taking a look at the defaults, delinquencies, the bad debts have piled up, and look what the banks have been doing mostly over the course of the past 12 to 18 months is ongoingly increasing their loan loss reserves. So what happens in this cycle is you go through a credit contraction, and you're seeing it in the data. In real terms, there's no growth in household credit. So we always look at, are we going to trigger a credit cycle because of lower interest rates? Well, not with debt ratios this high and with insolvencies and delinquencies and defaults running where they are, because there's the cost of credit, which you brought up, but there's also the availability of credit. And as the banks incur more loan loss provisioning on their income statements, the more they're going to cut back on credit. So the marginal borrower is going to get crowded out. So I don't expect this is going to happen for a prolonged period of time. We'll go through a new credit cycle at some point, probably a few years down the road. But without getting ahead of ourselves, what's staring us in the face between now and I'd say at least the next 2 years is going to be a prolonged period of balance sheet repair in the 60% of the economy called the consumer. That to me is obvious. And it is going to have, through the impact on aggregate demand relative to aggregate supply, tremendously disinflationary implications, if not deflationary.
So speaking of the next 2 years, how do you see the mortgage renewal wave playing out? Because the way it looks, that's a lot of money that's going to be sucked out of the economy. Do you think it's very much on the bank's mind looking at in their rate cutting cycle?
Well, it definitely is on the bank's mind. There's no doubt about that. And in fact, we've had a situation where the bank staffers, recently, it put out a report, and the estimate itself from the Bank of Canada economic staff, keeping in mind that average monthly payments for mortgage borrowers have already gone up 9% since the bank started tightening policy 2 years ago. They estimate that by 2027, that burden is going to grow by 17%. So you're 100% right. That gets sucked out of the economy, that incremental debt service, and it goes to the banks. Either goes to the banks or you end up, being delinquent. And then there's the impact about what it's going to have on household cash flows. And the Bank of Canada staffers themselves said that this increase in debt service payments, which isn't going to go away, it's baked in the cake. It's a matter of how quickly the bank can get interest rates down, to really mitigate the problem. But their own forecasts suggest that by 2027, purchasing power for these borrowers are going to contract by 3%. And in fact, the quote, the conclusion from that report from the Bank of Canada itself, here's what they said. They said in quotes, "A key insight from our analysis is that the downward pressure on consumption from rate hikes could last longer than the rate hike cycle itself.
Yeah.
And that's what I'm talking about, because the rate hike cycle was about 2 years. And they're talking now about the payback, the hangover, is going to be at least 2 years.
Right.
And this is all happening at a time when the run rate on real GDP is 1%. I mean, unless we miraculously go through a US economic boom or a global economic boom, what is going to offset that?
Right.
So I think that the Bank Canada's got a long road to hoe. The other thing we have to consider is that the Bank Canada talks about how everything is normalized. Now, I don't think 6.4% unemployment is really normalized. We're well above pre-pandemic levels. Underlying inflation is certainly normalized, but interest rates haven't normalized. That's what people don't realize, is that even after these 2 rate cuts, and here you're asking me the question about, are they going to manage to trigger a new credit cycle? If you go back 5, 10, 15, 20 years, the average policy rate in Canada, so I'm not going back to crisis levels, I'm taking the peaks and the troughs and the troughs and the peaks for the past 20 years. And the normalized policy rate is 2%. It's not 0 and it's not 4. It's in between. And right now the policy rate is still stuck at 4%. And they'll keep on going. But just to get towards the average rate where people were locking in, that's still 200 basis points away. So you know what? When I said before they've got to get to neutral 2 3/4, I was saying they got to do that immediately.
Right.
I don't know what they're waiting for. They're moving 25 basis points. I think they may have to step it up. But there is not going to be any real net stimulus to the economy, and there's not going to be any fresh credit cycle taking place until they get the overnight rate below 2%, which I think is where the primary risk is, which is why, again, I'm very bullish on the bond market. I think that the whole yield curve is going to be drifting lower because this economy is going to be needing much lower interest rates over the course of the next 12 to 24 months.
So the economy's turned to a point, things have worsened to a point that we're not in a here we go again scenario once rates go back down. Even at 2.75, that's neutral.
No, yeah, exactly. Because remember that monetary policy acts with lags. We're still working off the damage the bank already did during the tightening cycle.
Right.
Okay. Then with a lag, if they cut rates enough, if they feel confident enough that inflation is hit to the target and is going to stay the target, I think that they'll realize for that their big concern is going to be that they're going to go below target. And actually, Tiff Macklem is starting to voice some of that concern, and I think appropriately so. But we're coming at this from a level that is still so miles away from where the Bank Canada should be right now. Look, the cycle is the cycle. You know, the market cycle, the rate cycle, the economic cycle. These are just sine waves over time, centrifugal forces that really coincide with each other and overlap with each other. So yeah, you know, at some point things will turn around for sure. Maybe that's a 2027, 2028 story. Maybe you're right. At some point we will reignite the conditions for a new credit cycle. But if we're going to be reasonable and sort of let's just take this a year at a time. I'm not saying we've got to look out the next 3 months. That's very short term. I'm not saying we've got to look out, you know, the next 5 years. I'm saying that right now, I'd say for the next 12 to 24 months, I'm going to say that we should hunker down and buckle down and expect the economy to not just be weak, but weaken further, because we still have the lags from what the bank's already done that's still going to be kicking in. And then if they cut rates enough, and my hope is that they will, then with a lag, that'll kickstart the economy. But like I said, the Bank of Canada, they gave us the golden goose. You have to pay attention to what these people are saying, right? Whether it's Macklem or whether it's Jay Powell, you got to focus on their words. And they told us that even with their rosy-posy economic scenario, which really isn't that strong, but they don't have a recession in their forecast. Then again, central bankers tend to be economic cheerleaders, that we're going to be stuck with a deflationary, or if you don't like the word deflation, we'll call it disinflationary. That's more polite. We're going to be left with a disinflationary output gap through 2026. So we're not even talking about the next year, we're talking about the next 2 years. And that's going to put more downward pressure on inflation. The problem with this whole scenario, and it's very difficult. People talk about Goldilocks. You're hardly ever in Goldilocks. We went through a period of pernicious inflation. Of course, corporate profits did well. We had a situation where companies were forced to dole out more pay to their workers because there was a labor demand supply mismatch. That's all in the rearview mirror. And so what's going to be happening is that we're going to build up more slack in the labor market. And when you're talking about disinflation and deflation, what does that mean? It means that we're going through a negative profit cycle because prices are the prices that we pay as consumers, but it's the prices that businesses charge. So as you go through a negative profit cycle through this disinflation deflation, well, it means that hiring intentions go down. And then that means, as I said before, the unemployment rate goes up, and then wage trends start to go down. And there's this self-reinforcing process of wages decelerating or decline. Well, wages won't decline, but wages decelerating, prices decelerating, until such time as interest rates come down to a low enough level that this whole process subsides, which it will, and then we go on to the next cycle. Okay. And I will guarantee you that we will go on to a new upcycle in the economy. We'll go into your question about a new credit cycle. Absolutely. That will happen. Probably no sooner than 2 years from now. Okay. So it's still early to talk about it, but I respect the question. But let's focus on the here and now, or at least let's focus on the next year, and let's be prepared.
It's not going to be immediate. The next credit cycle.
No, not a chance. Look how long it took. I said before, I was banging my fist on the table when I was at Mother Merrill. And we got to what, 135% household debt income ratio, off the charts. We're like 177%. Look how long it took the US to go through. They went through their recession. And of course, that was reinforced by the financial crisis. But remember, the recession in the United States started in December 2007. Okay. That was 3 months before Bear Stearns went down for the count. That was 9 months before AIG, Merrill, and Lehman went down for the count. Okay. The recession started before that. Now, actually, in some sense, the recession created those conditions that generated the second round impacts of all that massive financial market instability. But I don't know how the country let itself get into this position where household debt to income is like 40 percentage points higher than it was at the tipping point of the worst recession that the United States had starting at the end of 2007 since the Great Depression. How did we get here? And then the next thing you know, interest rates go up more than 400 basis points, bumping against this gigantic debt load.
Right.
So that's how you're getting the questions you asked me about the Bank of Canada is default, delinquencies, mortgages in arrears, the pain this is exerting. Is that on the Bank of Canada's mind? Of course it is. And that's why they're starting to cut interest rates. But like I said before, without getting ahead of ourselves, all they did was eliminate last year's mistake. They should not have tightened those last two moves when the output gap started to shift towards excess supply. That to me was a policy mistake. All they've done so far is redress that. They have a long road to hoe on interest rates. And I'll get this question ongoingly, will it generate a new house price bubble? Will it generate a new credit bubble? No, well, that's years down the road because the loan availability from the banks and the non-banks are just not going to be there. And so there's going to be a process like in the United States. In the United States, the recession started in 2007. It took like 5 years before you got a normal recovery. I mean, the Fed didn't start to tighten monetary policy again until 2015 under Janet Yellen. It was like more than 5 years after the recession ended because it was such a feeble recovery that it still felt like we were in a recession, although technically we weren't in a recession. And that's what's staring us in the face. Look how long it took when you come off a credit bubble peak, followed by a period of much higher interest rates, which is what happened with Greenspan and Bernanke back in the mid-2000s. We're just replaying that movie. However, the problem is that the debt burden is so much more onerous in Canada today than it was back then.
Right.
So that's really, look, we have the template. You can ignore it, You can stick your head in the sand, or you can just learn from what happened. You don't have to go back to Japan, okay? You don't have to go back to those European countries, and that was more of a government debt problem, back in 2011, 2012. The template is right there in the United States. And it's true, we don't have, CLOs that are leveraged to the hilt or subprime mortgages. So I don't think this is going to generate a financial crisis. Like I said, the US recession was not caused by the financial crisis. People get that wrong all the time. The recession started, the NBER defined recession started December of 07 before all that other bad stuff happened. And it happened under the weight of excessive household debt burdens bumping against an aggressively tight monetary policy.
Right.
And then what happens is you go through a prolonged period of time where households do what? They repair their balance sheets. They embrace frugality at the expense of the retail community. I feel sorry for them. But then once we right size the balance sheets, we get interest rates down to appropriately low levels. Well, then we pave the way for the next cycle. But like I say, that's a couple of years down the road.
So you don't see house prices taking off in January then?
I don't think house prices are going to take off. And it's not as if we still don't have this chronic shortage of housing. But I think that the affordability constraint is going to prevent new entrants to the housing market from causing demand to boom. So, to have home prices go up, like I said before, to forecast any price, you have to have a supply curve and a demand curve. The supply curve in Canada, that needs some help. We need a lot more construction. There's no doubt we need a lot more construction. Housing starts continue to lag well behind net household formation, although maybe that will be corrected somewhat by the fact that we're not going to be following this, with truly insane immigration targets we've had over the course of the past few years. That pressure will subside. But the best cure for high prices, as they say, are high prices. And right now, affordability is just far too strained.
Right.
And although you'll say, well, but affordability ratios should improve as the bank cuts interest rates further, 100% true. And in fact, the Bank Canada's road to lower interest rates will now thankfully be reinforced by what the Federal Reserve is going to be doing. However, like I said before, it's not just about the cost of credit. It's also about the availability of credit. We have a situation where 2/3 of the mortgages out there have over 65% loan to value ratio. For first time buyers, 80% have a loan to value ratio of over 65%. So I don't think bankers, I don't think that you're going to be getting promoted at a bank right now by willy-nilly issuing out new mortgage loans. I think you're going to find that the trend will be towards tighter credit scoring and tighter credit guidelines. So getting a mortgage ain't going to be quite as easy as it was over the course of the past several years. That's what's going to change at the margin.
Okay. Wow. Like that's a lot to think about. Mr. Rosenberg, I've taken up quite a bit of your time. I really want to thank you for taking the time to go over all of this with us. And yeah, thanks so much.
Well, I just want to admonish you for one thing.
Okay.
Only my kids call me Mr. Rosenberg. You can call me
Okay.
Dave.
David. Okay. Dave or David.
It doesn't matter. Just don't
Okay.
call me Perma Bear, although some people might get that view after this conversation.
I don't think I've ever called you that. Okay. Well,
All
thanks
the
so
best
much,
to you.
David.
You
Okay.
too.
Bye now.